Hey traders, Jason here from Leavitt Brothers. In last week's video, I laid out criteria I was looking for to determine if the bounce was just a dead cat bounce within a newly formed downtrend or the beginning of an uptrend. Okay, I wasn't interested in guessing or predicting what would happen. I was fine leaving that to others. I was only interested in getting hints from the breadth indicators. In this video, I'm going to update those indicators. How have they progressed? Have they climbed above key levels? Or did they get rejected by key levels? Let's quickly run through updates of the charts that I posted last week. Okay, so here's the S&P 500 versus the 10-day moving average of the NYSE AD line. This is the chart I posted last week. What I said is that a characteristic of an uptrend is when the 10-day of the AD line gets above zero and just kind of stays there. It just kind of rolls up and down within an uptrend, and that's a characteristic of an uptrend. When it goes below zero, then you get a pause. Okay, so we're looking for this indicator to get above zero and stay there. So here's an updated version. As you can see, it has gotten above zero, and it's holding. It's been holding there for a couple days. Now this isn't very hard because being a 10-day indicator, it only uses 10 days worth of data, which means today's data point is going to replace one of these really big negative candles from 2 weeks ago. Okay, so it's fairly easy for it to maintain this level right now. The big test will be next week when all these negative indicators have completely fallen off the calculation, and then we'll get a truer sense of how strong it is. For now, I'd say, hey, good job. We got a big plunge to a 2-year low, big rally back above zero. This is exactly what the bulls want to see. Now it's got to hold that level. Hopefully it can build on it, and if it can hold zero and build on the level, then the bulls will be in good shape. Okay, here's the S&P 500 versus the AD volume line. Obviously the AD line gives equal weight to all stocks. It doesn't matter if you're a multi-billion-dollar company or if you're worth 200 million, you get equal say-so in the AD line. AD volume line gives higher weight to stocks that have more volume. So typically the stocks that have bigger volume are the stocks that are bigger and have been around for a while and they're more solid companies. Generally speaking, not always. So it gives a little bit different view, but you tend to get the same picture. Okay, this is last week's chart. Like the previous chart, I said I want this to get back to zero, get above zero and stay there. That'll be a characteristic of an uptrend. This is what has happened. Like the AD line, the AD volume line has indeed gotten above zero, and it's holding for now, so that's good. Okay, it's not in fantastic shape, but it's not in bad shape. Okay, I would say pretty darn good considering the S&P fell 340 points. For this to completely reverse course and get above zero is a good step one. Here is the chart I posted last week of the S&P versus NYSE new highs. The point I made was that when new highs hang out at a low level, like they did here, like they did here, when they hang out at a low level for an extended period of time, the market tends to pause. It tends to go sideways, as you can see, like here and here. When it drops to a lower level and then immediately recovers, you tend to get a much shorter pause. So the question I had last week is, how long is this going to stay down here? Is it going to immediately start expanding and get back, and get up to a healthy level, or was it going to stay down there? Okay, so here is today's version of the chart. As you can see, it hasn't made much progress, even though the S&P has rallied over 200 points, has recaptured more than 50% of its loss. New highs among individual stocks are still very depressed. Okay, so if this indicator has any type of predictive ability, which I think it does, the market isn't likely to go up much more unless this indicator starts to expand. Okay, it's not a very sensitive indicator. It's not going to move up immediately. The reason why is because after the market drops a lot, it takes some time for stocks to get back up to their previous highs. But after a rally has been in place for a week or two, you want to start seeing individual stocks hitting new highs. Okay, it's not happening right now, so I would say this puts a little bit of a damper on things. Right now, the S&P is trading in a little bit of a range, and if it attempts to break out from this range, it's probably not going to go very far unless new highs start to expand. Here's the S&P up top versus the NYSE high-low differential. It's just the highs minus lows. Characteristic of an uptrend is you get high-low. The high-low differential basically oscillates above zero. It's pretty simple. If highs consistently beat new lows, the market tends to do pretty well. when the high-low differential gets to zero and hangs out there, you tend to get a pause. When it dips below zero, you tend to get a pause or a little bit of a pullback. This was the situation as of last week. Lots of up and down movement. We climbed right back to zero. Let's see what it looks like now. So right now it moved back above zero, but not by much, and now it's sitting back at zero. So no progress has been made here. Okay, we want to see progress. If the market's going to continue up, if it's going to maintain its health that it's built over the last week or so, we want to see this indicator move up. If it hangs out down here near zero, the market's not going to move up very much. Okay, two more. Here's the S&P 500 down below. Up top is a percentage of S&P stocks above their 20-day exponential moving average. Characteristic of an uptrend is when the indicator oscillates above 50%. And when it does that, the market tends to generally move up. When it drops below 50%, like it did here in the red box, and over here, you tend to get these pauses. Okay, no big deal. Market moves up, pauses, moves up, pauses. It's pretty normal. So what I was looking for last week is, can this indicator get back up to 50%? Can it expand above that? Can it maintain that level? And tell us that, like, hey, a majority of stocks within the S&P are trading above this key moving average. Let's see. So here's the version of the indicator as of yesterday's close. You can see it got above 50% and then it fell. Today the market's doing well, so it's probably back to 50%. Okay, I'd say, hey, good job. It went from an extremely depressed level all the way back up to 50%. That's pretty good. It took a lot of energy, a lot of effort to get there. If it's going to continue, if the market's going to continue up, if a bottom was put in place 2 Fridays ago, this indicator needs to get above 50% and stay there. Okay, it's done well to get back to this key level, but now it's going to build on it. And if it can't build on it, it doesn't mean the market's going to crash or anything. It just might mean we have a couple weeks or a month of sideways moving. Okay, so you need more than 50% of the stocks to be trading above this key moving average right now. Excuse me, it's hovering at that level, so not bad, but not great. Last one, similar to the last one, this is the S&P 500 down below versus the percentage of S&P stocks above their 50-day moving average. Okay, big moving average, closely followed by a lot of institutions, closely followed by a lot of traders who trade longer term, want to see the big picture. The 50-day moving average is very important to them. So similar to before, you get moves up, then a pause, moves up, pause, move up, pause. Characteristic of an uptrend is when this indicator can basically oscillate or hang out above 55%. When it drops below that level, the market tends to pause or pull back a little bit. So obviously we got a big plunge, a couple year low, and then so the question I had is, can this indicator get back up to 55%? Can it get back up to the blue box that you see here? So this is what it looked like as of yesterday's close. It rallied up to the high 40% area, dropped back down. With the market being strong today, it's probably back up to 45%, maybe the high 40s. So I'd say, hey, it's made progress, but not enough progress. Okay, the market expended a lot of energy to get back to where it currently is, and a lot of the indicators moved up with force, but they're at levels that are kind of separating uptrends and downtrends. So there's still work that needs to be done. Okay, overall, I'd say the market's in okay shape, but not necessarily great shape. Okay, the S&P fell 340 points and then rallied back more than 200. The rally pushed all the indexes back to their 50-day moving averages, and many of the indicators back to neutral levels. In my eyes, the bulls still have some proving to do. They've done well the last 9 days, but they've only managed to put the market back at a neutral level. Okay, they certainly can't rest or get complacent. There's still work to do because it wouldn't take that much to tip things back over again. Okay, come check us out at Leavitt Brothers for a very small annual fee. We'll save you a ton of research time. Okay, our weekly report, which discusses the long and short-term trends and the staying power of those trends, is only $149 for the year. Our sector breakdown and trading ideas report, which offers many new trading and investing ideas from the market's leading groups, is only $299 for the year. Okay, one good trade pays for your subscription for the entire year. Come check us out.